If you've been shopping for a DSCR loan, you've probably heard lenders throw around numbers like 0.75, 1.0, and 1.25. If nobody's explained what those actually mean, they just sound like arbitrary hoops to jump through. They're not arbitrary. Each one of those numbers represents a different risk profile to a lender, and that risk profile is exactly what determines your rate, your down payment, and how much cash flow cushion you need in reserves. By the end of this video, you'll understand exactly why a 0.75 DSCR loan costs more than a 1.25 DSCR loan, and how to figure out where your own deal actually falls. Quick refresher before we get into the cutoffs. DSCR stands for Debt Service Coverage Ratio. The formula is simple. DSCR equals gross monthly rent divided by PITIA. PITIA is your full monthly payment. Principal, interest, taxes, insurance, and HOA dues if there are any. So if a property rents for $2,500 a month and the full mortgage payment is $2,000 a month, you divide $2,500 by $2,000 and you get a DSCR of 1.25. That number is the entire story a lender needs to know. Does this property pay for itself, or does it need help from the borrower's pocket every month? That's the whole risk question. Everything else, the rate, the down payment, the reserve requirements, flows from where you land on that scale. Let's go through the 4 major tiers lenders use. At the very edge, you've got no ratio DSCR loans. These don't use the property's cash flow to qualify at all, because the lender has zero visibility into whether the property can pay for itself. This is the highest risk tier. That shows up in the largest down payments and highest rates. Next tier up, 0.75 DSCR loans. This means the rental income covers about 75% of the mortgage payment. The property is running a monthly shortfall. Lenders usually require extra liquidity reserves to prove the borrower can absorb that negative cash flow if something goes wrong. Then you hit 1.0 DSCR, the break-even point. Rent exactly covers PITIA dollar for dollar, but there's still no cushion. One missed month of rent or one unexpected repair, and the property is underwater on its own. That residual risk is why 1.0 still doesn't get the best pricing. And at the top, 1.25 or higher. This is where the property is generating 25% more income than it needs to cover the full payment. That extra 25% is the lender's margin of safety. This is the tier that gets the best rates and the lightest reserve requirements on almost every lender's rate sheet. Here's the part people actually care about. Why does the rate change so much? It comes down to one thing: risk-based pricing. Drop into the 1.0 to 1.24 range, and you'll see a quarter to half a point added to your rate. Fall below 1.0, and that premium roughly doubles again. Rate isn't the only thing that shifts at each tier. A few other things move right alongside it. Higher risk tiers demand more skin in the game, extra months of reserves, and higher minimum FICO requirements as the ratio drops. So what do you actually do? First, before you fall in love with a property, run the DSCR math. That tells you which pricing tier you're realistically shopping in. Second, if you're on the edge, consider putting a little more down to push into the next tier. Sometimes a few $1,000s extra saves you far more over the life of the loan. Don't assume a lower DSCR means you can't do the deal. It just means you need to structure it correctly, going in with eyes open on the requirements. If you're working on a deal right now, reach out directly and I'll run the numbers with you. Subscribe for more breakdowns like this, and I'll see you in the next one.